Hello everyone, my name is Danny. In today's video, I'm gonna introduce the risk management in the future trading. It's most important part before open any position. If you are a good trader and you don't know how to do your risk management, is very dangerous. You're gonna blow your account in the one trade only. As a trader, we don't know what's gonna be happen, what is next 5 minute or even 1 minute candle is. Each second is gonna be change the direction of the trade. We're gonna be have a strategy, but before have a strategy, we need to do the risk management in the future. If you stay on with me, you learn a lot of things, how to manage your risk and how to be survive in this market. If you are not do this one and for example you have $1,000 in your account balance and do it in one trade, one day you're gonna be have a 3,000 or maybe 5,000 and the next trade you're gonna be zero. If you're not doing this one, you're gonna be broke. Let's go and find it out. What is leverage trading? Leverage trading allows the trader to control the more equity on the market with a small account or a small margin balance. At this example, you can see with the 200 with the leverage of the 50, you can control the 10,000 value of the asset. Understand the trading on the leverage. It's really important because understand the trading on the leverage as a have a good positive on the market, it has a negative as well, because as much as you win, you risk a low amount of money, you're gonna be on the, for example, 10 times your money, and you get a profit 10 times that you are getting with your margin only. You loses is gonna be same to if you, for example, $100 on the $10,000 value, you're gonna be lose on the 10,000 value of your money. Leverage trading, it doesn't mean to be if you have $1,000 in your account balance, straight away put a $10,000 in your one trade and going for the trading. We use the leverage for trading. We're gonna be use the trading with a low margin and with a high control the asset. We're not gonna going crazy for the high leverage, because as much as it's high leverage, it's gonna be more potentially to lose them more as well. I'm gonna go in for the one example. Suppose the trader has $1,000 on their account but feel that's not enough for the trade. They might then use a leverage, for example 10x, and invest in like one asset. That is completely wrong, because that is thing that is only the exchange or broker looking for it. If you have $1,000 on your account balance and put it on the one trade, exactly that is exchange looking for it to take off your money from you. The benefit of the leverage is mean you need to control the more equity with a low margin balance. Let's go and for the good and bad on the leverage trading. Imagine that you lost a trade. Trader X, we have a two trader. Trader X has a 10% on the capital, use the 10% on the capital and use $1,000 for each trade. Trader Y do that same thing, but Trader X is going to the 50 leverage. The liquidity that is his own is around the $50,000, and the result of the value the 100 pips lose is gonna be $500 he's gonna lose. Is $1,000, they put a 500 lose. He lost the 50% of his position. He owned the only 50% of his trade. Trader Y is gonna be same situation, going to the leverage of the 5 and going for 5,000 liquidity control. He lost the $50 for the 100 pips that is lost, and his liquidity is gonna be 5% lose, and the 95% is gonna be remaining in his account balance. We're gonna going for the next. That is good thing and bad thing about the leverage trading. You're gonna be going for but if you imagine that the price is going to your direction of your trade, you're gonna be Trader X is gonna be 500 plus, and Trader Y is only $50. Gonna go for the next episode and do some strategy for the trade. Only use the 1% and 2% for each trade. Do not over trade. The maximum trade that you can be open 5 to 7 only. You can't manage more than 5 to 7 if you're being realistic a little bit, and if you are full-time trader. Use a leverage to control the more liquidity with the low margin risk, not going for the all of your account balance on the one trade only. Don't going for the high leverage, because as much as you're going for the high leverage, as much as you get a profit from the high leverage, you're gonna be other direction is gonna be lose the more than the others. Don't be greedy about the market. We just get into the market to take our share and get out from the market. That's what we're gonna do on the market. If you get your target is being reached, you need to get off from the market or make it risk free if you're being more greedy. And maximum involved, that is really important. Be aware under this one. Maximum involved in the trading each days or each week, or depend on your trading that you do, is 3% on the pessimistic view. Imagine that you have a 3 trade open, right? And each of them is 3%. If you lose all of the 3%, you're gonna be do not open any position under this one, because your 3% of the lose is been enough. You don't know what's gonna be happen on the next trade. We're gonna be stay on the market and work with this market. If you do the trading on the more than 3%, even 4%, even 5%, if you lose, some people is going to the 20%. If you lose 80% of your 20% of your account balance, it's very hard to keep it up and build it again. And the maximum risk that you can do it, 3% for each trade. If you are 3% of your account balance is being on the market, you are not allowed to open any more position because of the risk management. professional trader never make more than 5 to 7% of the capital per month in the average. Your competitor is professional trader. Located yourself between them and expecting to get a more. A lot of advertising on the market, on the internet, you can see that 300% per day, 400% per hour, 600% per month. This is completely wrong. If you are doing this one, you're gonna be blow your account easy. Nobody hate the money, but we're gonna be stay on the market and working on this market for a while. We're not gonna be open the position one trade and going for the one trade, and the next trade is gonna be our account balance is become the 3 times, and the next day is gonna be 0. Trading based on the risk. If you are not trader and you want to gambling, that is not good place for you, because this gambler you're gonna be lose your money. It's better to buy a lotto or going for the casino for the do this one. Let's go on to the final step. We're gonna be calculate your leverage. Imagine that you have 10,000 your capital. Each trade that you can lost is 1% only. It's better to don't put a more than one on. My strategy is any trade I'm not risking more than 1.5 to 2% of my daily limit. You don't know, maybe next hours is gonna be good potential for you to go into the another position. If you risk your 3% and you're gonna be risk another 1%, you're gonna be lose your account balance. We're gonna go in for the chart and they're going for the exchange on the calculation and show you how to calculate your leverage and how to risk your manage your risk. Understand how to adjust your leverage. Going to each exchange has a different calculator, but assume that all of them is pretty much same. We're gonna go in for the calculator here. As you can see here, we have a 2 short and long setup and the profit and loss. We're gonna go in for example, we're gonna go in for on the one Ethereum. We have a quantity of the one, choose a quantity of the one, and the entry price we're gonna go in for for example 1200, and we're gonna find it out how much leverage we are allowed to put it on this trade only. We're gonna our stop loss for example is 1100, and we're gonna be under this one. We're gonna adjust our leverage because we are not allowed to more than, if the trade going opposite of our position, we not allowed to lose more than 1% of the account balance, right? We should know how much we put it. For example, we are allowed to lose only 1%. Under this example, simple example, we are under like we put $100 for this one. We're gonna be open the $1,200. If going against us our trade, we just only lost only $100 on the trade. We're gonna be adjust our leverage and find it out how much we gonna be lose. And this one we need to find it out how much we're gonna be lose. The quantity is not matter because we put it on the USDT. The quantity is not matter that much because we just use it as like a sample only. The only that is matter for us, the ROI and profit and loss. We're gonna be adjust our leverage to find it out how much we are allowed to lose. For example, we are not allowed to more than 11.7 or maybe 11.9. Yep, we are maximum leverage is going for 11.9. The maximum leverage that we can put it on our trade is 11.9. For example, instead of the put $100, we're gonna put it $200, right? We just allow to put only 50%, lost the 50% of our trade only. Under this example, we are allowed to going for the 6 leverage. And the maximum leverage for us is gonna be 6 only because we put a 200. Now we're gonna put it the $400, but we are allowed to lose just only 1% of our account balance. The account balance of us is 10,000, 1% 100, but we're gonna put a $400. The maximum leverage for us is gonna be 3 only because 25% of the 400 is gonna be only allow us to put a 3 only on the leverage. It's very you need to really cautious about this situation. If you're going for the over 1% and the trade going against you, you're gonna be lose you're gonna lose the more than you are allowed to lose on the one trade. I'm gonna describe the isolated and the cross margin. Isolated is mean if you have a $1,000 on the account balance and you put $100 on the one account on the one trade, that just only $100 is being affected on the liquidation price. And the for cross margin, just only different with the isolated, you're not gonna be, if you open the position as $100 and your account balance is $1,000, your liquidation price is gonna be over $1,000. It's better to put it on the isolated because it's more safer, but sometimes it's better to go in for the cross. I'm gonna introduce you in the next level. One more thing that I'm gonna add it to this point. Try to put your stop loss and take a profit by yourself before you getting liquidated, because if you getting liquidated, you between 5 to 10% depend on your leverage. It costs you more than your stop loss because of the liquidation price. That is kind of the penalty for your liquidation. I hope so you enjoyed the video. That is part 1 of the risk management strategy. This is really important to obey it, this rule, and your strategy and your risk management strategy. If you're not doing this one, you're gonna be broke in less than a month. I'm gonna prepare the next video in the next couple of weeks, and the part 2 and even maybe part 3. If you like the video, you can smash the like button and subscribe to my channel. I have a Discord channel as well, a lot of free education in there. And see you next time, guys.